that's why it's 60% fixed income. In the audience, if you're 20 years old, then you will have 20% fixed income, and 80% would be in stocks, meaning that you're taking more risk than he is, which makes sense because he's 60 years old. So another individual here, Christopher Farley, follows a dividend growth strategy. Another strategy you can go and use. He's a retired Canadian naval officer. His portfolio is now 7 figures. So what this individual does is he buys stocks that increase dividends. So for example, Ambridge and TransCanada. So they pay, not only do they pay a dividend, but they have a record of increasing their dividend year after year. And Tim Hortons and Royal Bank are also examples.
Sorry, but can you define dividend?
For sure. So dividend is something, so if you buy a stock, let's say Tim Hortons, usually what they'll pay is a dividend for every quarter. So 4 times a year, they'll, let's say, give you 10 cents a share. If you have 100 shares, then you get 100 times 10 cents. And you do that, they'll pay it out every quarter, typically. So second type of stock that he buys is U.S. consumer stocks that with revenue overseas, such as McDonald's and Procter & Gamble. And what's good about this strategy is these stocks have revenue from overseas. So if the U.S. economy is bad, it doesn't really matter as much because they get revenue from Asia, Europe, and other places. So, and Procter & Gamble and McDonald's are good examples. And his result is, this Christopher Farley, his dividends, he gets dividends of $52,000 a year from his portfolio. So he just sits on his portfolio, he gets $52,000 a year. And these dividends increase 7% a year, so that's very sizable. So now we've explained to you some techniques that you can go out and use to invest. We're going to revisit the example that we showed you earlier. And this is with Manulife, this is with, I was put in charge of a family member's portfolio recently, and this is the first stock that we bought. Again, like we said before, November 3rd, bought the stock, sold a month and 7 days later, and the gain is, net gain is 560, so that's after the trading costs are included with the dividend, and the gain is a rate of return is 30% in 1 month and 7 days. Now, that's the great thing about doing buying and selling stocks, because you can get returns like this, and if you're really good, then you can even get returns that are better. Having said that, I'll just point out that when you start out, don't expect to get this every time, or don't expect to get this right away, because typically a good hedge fund will give you a rate of return of 20% a year on average. So this is a very good rate of return. You might get this, you definitely have the potential of getting this when you do stocks, and that is why people will spend so many hours each day doing stocks, because the gains are really sizable. So we're going to go through basically fundamental analysis, what we explained earlier, and go through this example and show you how you can actually go out and find a stock like this. So why did I buy the stock? So first of all, it's a sound business. Manulife Financial is an insurance company, and it's in the insurance sector. And it's a sector that was invented a couple of 100 years ago. It's here to stay, probably forever. Because sometimes there are stocks that look cheap, but their sector or the company is in decline. Well, this is not that case. Bearish sentiment. A lot of people were really bearish about the stock, meaning they don't think very highly of it, and that's because, if you can see from the chart, which goes from before the financial crisis, the stock used to be at close to $40. During the financial crisis, it fell to around $9.70, and then it went back up to around the $20 level, and for a few weeks before I bought it, it was trading sideways. People were basically not willing to touch the stock, and sometimes is when there are people who are not willing to touch the stock, that's when you should buy. And vice versa, when everybody's going into a stock, that's when you shouldn't buy. And that's called contrarian analysis. And the third point is that it's a discrepancy so the stock was reporting earnings soon. I bought the day of the earnings, and they reported earnings the afternoon after I bought it. And analysts had a big discrepancy about what this company was going to make. Some analysts were calling for a loss of 20 cents, some were calling for a loss of 60 cents, some even a loss in $1, so per share. And that's a huge difference. So these analysts didn't really have a clear idea of how the company was going to do. So if they were bearish about the company, and they have no idea how the company is going to do, well, guess what? They could be wrong. And thirdly, it pays, at the time when I bought it, it was paid a dividend of 4%, which is very sizable. GICs now, even the best ones, you can only get 2% a year. So this is kind of like fundamental analysis, and these were the reasons why I went and bought the stock. And now let's take a look at the results. So the result was that the very next day, the stock went up 13%, and that's because they announced earnings that beat expectations. And as you can see from the chart, it's gone up ever since, from 12.60 when I bought it all the way to 16.72 when I sold it. Went a little bit higher even afterwards. So we wanted to share with you a secret in investing, since you all came out, so you deserve, you know, something even more special than we've already shown you, and that is buy and hold is a fallacy. And a lot of financial advisors will tell you to buy and hold. They'll tell you to invest, and they'll tell you to keep putting money in, for example, for retirement year after year, and don't worry about it, just keep putting money in. And we're telling you now that buying and holding is actually not the best thing to do, and that you should actually, well, buy low and sell high. So you can see. So this is to show you why. This is a graph of the Toronto Stock Exchange from 1996 to this year. So as you can see, it's been a very rough ride. A lot of bumpy, it's a very bumpy chart. So this is the low in March 9, 2009. This is the low in the financial crisis. And as you can see, if you can draw this point backwards in time, it would be the same level as around in year 2000. Now, meaning if you had gone in and bought stocks in year 2000, 9 years later, your money would have been at exactly the same level. Now, you might think, hey, it's exactly the same level, that's not that bad. But when you think about inflation, which is around 2 to 3% a year, your money is actually losing value at 2 to 3% a year for those 9 years, while the nominal value stayed the same. So in essence, the value of your money actually went down over 9 years. Another even more dramatic example is the US index, which is the S&P 500. You look at the March 9, 2009 low again, and from that point, tracing back to in time, you're looking at the exact same level in 1997. So essentially, if you had bought stocks in 1997, buy and hold, listen to those financial advisors, guess what? 12 years later, it's exactly the same level. And worst of all, inflation would have hurt that money for 2 to 3% per year. And that's exactly what a lot of people experience. And in fact, a lot of people who were saving for retirement, they call it 401k in the US especially, they saw their money decrease in value by half. Now, these were people who were buying and holding. So before the financial crisis, you had S&P over 1,500 points, down to around 750 points, so that's half. And these were people who, of course, were very disappointed, very angry because their retirement savings decreased by half in value, listening to financial advisors. So we're just going to give you some additional resources where you can go out and use and start learning how to invest even more. The first one is basically Global Mail, a report on business. So when you go on the Global Mail site, you hit business, and you'll see this site. The second one is Globe Investor. So basically, again, you go on globalmail.com, you hit investing. The good thing about the site, the Globe Investor site, is that you see 5 charts. Chart of the S&P 500, TSX, Dow, price of oil, and gold. And these are charts that refresh around every 30 seconds. So I'm always on the top 2 sites. Reuters is another good site. While the first 2 are very Canadian focused, Reuters has a very international and US focus. Last 2, Market Watch and Barron's. Even though you may not have heard about these 2, these are in the same network as the Wall Street Journal, so they're highly trusted sources. Market Watch gives you up-to-the-minute news. If you're looking for news right up to the minute, it gives you that. Barron's is a site that gives you pure analysis, and most of these are from actually from the US, so they give you analysis of stocks. So just to end it off, basically, if you go out today and start investing, even if you're a conservative investor, if you decide to take charge of your investing, take charge of your financial future, you'll grow your money rather than watching it fall because of inflation, and rather than letting financial advisors eat away your money with fees. And if you're really good, if you're really aggressive, then you have the potential to make lots of money, like the Manulife example, or even better. But what I've found is that investing isn't just about the money. Now, for example, Harry on earlier talked about herd mentality, and that is buying what everyone else is buying. Now, herd mentality isn't everyone, because that's in your biology. It's a result of evolution. But at the same time, everyone does it, and it's not your fault, but it's in everything that we do, something like herd mentality. By investing, you notice things like these, like herd mentality, and you basically notice limitations in yourself. And by knowing these limitations, then you can overcome them and basically become a better person. Another example is when you invest in stocks in other countries, for example, in the US, in Europe, in Asia, not only are you just investing money, you're also learning more about these other countries. And you become, what they say, more cultured. So investing isn't just about the money. Isn't just about the money. It's also about becoming a better person, being the best person you can be. Because learning about this area of your life and getting control of this area of your life, while instead of just listening to financial advisors, what that does is when you can take care of this area of your life, the positive benefits will also flow to other areas of your life, and you will start to see it. When you have good financial health, that positive effect will flow into other areas of your life in everything you do. So we just want to thank everyone, and